Hi everyone, I'm Ken, the inventor of the CTKS method. Each day I seek to give you an edge in the market using professional smart money rules and thinking, based on my more than 30 years experience in financial markets, to assist you to become more of a financial blessing to yourself and those you love. If you want to get the institutional edge, please subscribe and you'll find we have one of the best communities on YouTube. Let's run the numbers. Bitcoin is currently down 0.89% to 24,594. Ethereum is down 1.56% to 1684. All professionals have a methodology that they use and bring to the market's analysis. The first thing to understand, without knowledge you will encounter losses. Losses are the tuition fee of the markets already, but without knowledge you're in a lot of trouble. The first thing that we do is to get the foundations, the critical understandings of the market. Then we seek to get ready to aim and fire. Aiming is all about finding the market's focus and about having a professional mindset. We fire last, we do not fire first. And this is what separates professionals from retail. Professionals have many rules that they actually guide their investment and trading decisions by. Rule 252, be prepared and not scared. Trading and investing is a mind game, and so many people say, I'll trade and invest when the market is calm, when the seas are calm, not a wave in sight. I'd like you to think of the market very differently from now on. Just think that you're the captain of a ship inside the markets. You're not a normal captain, you're an extreme sports captain. You love choppy seas. The choppy seas is where you have the capability of testing your knowledge. Financial markets are definitely like the sea. Price is always moving in a wave. From time to time you will get tsunamis, but most of the time it's relatively calm. Rule 252 from the Masterclass, prepared and not scared. What does it actually mean? You're mentally prepared. You know price is always moving in a wave, and it can move up very dramatically and it can move down very dramatically. But you're not scared of things. You're an extreme captain. And you're definitely not scared. If you think of any professional discipline, say for example a doctor, a lawyer, an engineer, an accountant, or any other of the professions, they all require a lot of knowledge. These 5 areas are the structure of the masterclass. The first thing that people need to do is to get their foundations. When they've got their foundations, they need to move on to understanding the trend, how things actually operate inside the market. Then they need to understand their timing. How do they get in and identify reasonable, profitable opportunities? Getting the mindset correct is very important. Your psychology will dictate your profitability. And then we get into actually pulling the trigger on trades. And I share what actually occurs there. And also in the trigger section, there's a living masterclass section, which just keeps everybody up to date. And there's one particular LV video that I want to show you today. I'd like to give you a bit of an update on LV13, recession prediction, how close we are to one. I do a deep dive inside the masterclass, and it's pretty deep. When we looked at LV13's chart, I had previously the NASDAQ. I popped on the S&P 500 because I want to actually show you more history. In that particular masterclass video, I explain how the 10-year and the 3-month are critically important things to look at. 10-year yields and 3-month yields. 3-month yields are typically what banks give as interest rates to customers for their savings. 10-year yields tend to set the benchmark on what banks loan money out into the economic system. I also explain how bond yield curves are actually formed and what they mean practically. When you have a normal yield curve, you have short-term rates lower than long-term rates. When you have an inverted yield curve, you have short-term rates being much higher than long-term rates. That's clearly not a good thing. Arturo Estrella was the Fed economist in 1989 that came up with the terminology of yield curve inversion. Arturo tracked the 10-year and the 3-month spread. And this is what you can think about this, is it's pretty much like what depositors get for their money and what banks loan out their money at. It's just a very simplistic way of looking at it. When these two reach zero, the yield curve becomes inverted. When you get an inverted yield curve, it's not the best. And why is it not the best? Because it's a predictor of forward-looking recessions. But there's a lot, the jury is still out as to when the actual recession occurs. It can occur quickly or it can take years to play out. So you've got to bear this in mind. One thing that I want to draw your attention to is that we've seen the yield curve invert, and it's inverted quite substantially. If we look at this inversion that occurred just recently and we look back towards around 2004, we can see that yield curve inversion was quite substantial. But it takes time for things to play out. We've seen our yield curves inverting, but note the amount of time, and just think about this. This is the S&P 500. It took time for the yield curve to come down, bottom out, and then go back up. And look at this recessionary indicator, this red line, just arcing up as the markets came down. We actually need to keep our eye on this. This is like a bit of a storm warning because we're getting a bit of an uptake in recessionary prediction. And when you think about that, what people will do is they'll say, oh no, a recession is coming, sell everything. They'll see the storm cloud on the horizon and they'll just sprint. Smart money thinks incredibly differently. They know the waters are always choppy, always. They get prepared and they don't get scared because getting on the right side of the percentage when the markets are coming down is one of the best, most profitable investments and trades you can ever make. It's actually pretty fascinating. When the yield curve inverted, what happened to the markets? They started to rally. This is one of the things that has caught a lot of people off guard. There's been so much negativity inside the market because of yield curve inversion. But please note, yield curve inversion can take 3 to 6 months, even 12 months to play out inside the market. Masterclass students, you get a copy of my live chart in LV13. One thing to note is the recessionary indicator at the moment is at baby levels. And what do I mean by that? One thing that we keep our eye on is the recessionary indicator is just up to around this particular horizontal line. If we look at the GFC and what the economic turmoil that actually occurred after that, we can see the recessionary indicator just peaking up here. What actually we also see in the March 2020 sell-off, the COVID and US liquidity crisis sell-off, it came up to around those GFC levels as well. What about the dot-com crash? That was all about the recessionary indicator going up far less and then coming down. But you can notice price action went down a lot further after it peaked. What about when this one peaked during the GFC? The peak was very close to the bottom of price action. And the peak, well, it was just a literal blip when it came to C19. And when we look back to the Great Recession of the 90s, we actually see that it spiked up higher than the recessionary indicator, spiked up higher than what it did with the dot-com bubble. It's very fascinating. And we see that on the way down, it's giving you an understanding that when the recessionary indicator comes down, it's almost as though it's saying, yeah, we've pretty much found the bottom. But just be aware of these particular indicators. They don't update daily. They update infrequently. And there are two shaded lines here because on this chart, And actually, if I just zoom in a little bit, you could probably see it more. You can see there's a shaded area and a different shaded area. They're two recessionary indicators. This one tends to call out recessions just a little bit earlier than the other one. So I like to have a stacking of probabilities at all times, because this is what professionals do. We really want to see the market from every facet of the market's diamond. What does this mean to you practically? It means that you have to apply Rule 252. You have to be prepared and not scared. Keep on marking your charts up with the CTKS method, because it gives you where smart money will buy and sell. Smart money does not leave the market. Retail does, but smart money never leaves the market. You'll see different economic commentators out there saying, the dip is not over, things are going to get worse. And that's a terrific thing to sell newspapers. And we can see statistically that that is a storm cloud on the horizon, but it doesn't mean it's going to play out. But you may say, Ken, that yield curve inversion is the worst yield curve inversion ever. And it is pretty steep, and it had occurred very, very quickly. But why did this occur? Because the federal funds rate has come up the most it's ever come up in history. And what do we also see? And if you've been following the channel each day, you already know this. What is the health of the labour market? Please let me know in the comments. One thing is without doubt, this will be a trader's market for the next foreseeable period of time, because there's going to be a lot of turbulence. Learning how to trade is incredibly important because it times your buys and your sells more effectively. Unfortunately, a lot of retail traders and investors look at price action like this, and when they're not doing it, they're fitting different methodologies to price action that have got nothing to do at all with market structure. What we do instead is that we apply the CTKS method to form smart money buy areas and smart money sell areas, and it's very, very important to know where these particular levels are. When you know where smart money buy and sell levels are, you effectively get X-ray vision. You know that a smart money buy area is one which will be defended by buyers. Smart money sell areas will be defended by sellers. And you will see that price ping-pongs between the two. It ping-pongs between a smart money buy level and a smart money sell level. Smart money sell levels actually slow the upward progression of price. And if you get a lot of weight in the smart money sell levels, they can push price down. But you'll see time and time again, even though price comes down, it's always getting caught by smart money buy levels. That's why we actually do this analysis. We want to know if the wave crashes against us, how much the damage could be. Again, we apply Rule 252. We're prepared and not scared because we know where the CTKS zones actually are. The CTKS method is the closest thing that you will ever get to certainty inside financial markets. Retail investors and traders only have one thought: the market is either going up or it's going down. Professionals do not do that. We understand that we control the trade or investment, but that market controls the return. And that return is based on our understanding of how to stack probabilities. The greater your understanding, the greater your knowledge, the greater price will move in your favor because you know what you're doing. If you treat the market like a casino, you know what casinos do: the house always wins. Instead, it's important to think differently about financial markets. Think about synchronization. Financial markets exist to transfer money between the desynchronized to the synchronized. And how do you get synchronized? You have a lot of rules. And you have a systematic way of looking at the market. And you have the knowledge, because when you don't have the knowledge, you will have losses. And when you do have knowledge, you will have losses as well. Losses are just part and parcel of financial markets, but the losses will be far, far less, and the profits will be far, far greater. One thing to always note is that indicators phase in and out of accuracy. But that's a topic for another time. I hope this video has helped you to come to terms with the concept that there's a lot of people still out there saying the markets are going to tank, and you now know why. But the markets always tank. It's just a question of when. You cannot avoid it, but you can be prepared for it. If market turbulence is keeping you away from getting into the market, just start small and scale. Build up your knowledge by and through experience. And the most important thing that you can ever do is to mark up your charts with the CTKS method. Also, keep your mind very, very positive. Just because there's a stormy sea doesn't mean it's not a great day for sailing. And always seek to develop better habits, because a better mind creates better profitability inside the markets. Have a great weekend ahead, my friends, and I look forward to catching up with you tomorrow. Bye for now.